Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Credit Suisse sees clients pull over 61 billion francs from the bank in its first earnings since the UBS takeover deal were live in Zurich. European stocks and futures fall before data this week that may illuminate the path forward for interest rates, or it may not. Treasury yields tick lower. Plus, the Chinese embassy in France pulls a transcript of an interview in which the ambassador questioned the independence of the former Soviet states, remarks that unleashed diplomatic fury across Europe. So first, let's check in on the state of the markets. We're also getting some Ifo figures. Business confidence index rising 93.6. It's a bit better than expected because we were expecting a 93.4 figure. Now, European stocks are wavering a little bit. Again, a lot of the focus this week will be on earnings. We have a lot of the big tech earnings in the U.S. That will filter through sentiment here in Europe. And then, of course, we have GDP out of the U.S. We have a lot of data that could give us an indication or not about what not only the Fed but other central banks do next. European stocks for the moment pretty much flat. Basic resources amongst the industry groups that are losing the most. S&P futures also a bit lower, down 0.3%. But then when you look at the quality of the earnings, they haven't been bad at all. Out of the S&P 500, I think about 20% have reported earnings, and 40% of those better than expected. The U.S. 10-year yield, actually the U.S. 2-year at 4.14, and then iron ore futures down 4%, and that's really dragging basic resources and energy stocks down. If you look at the FTSE, down 0.1%. We'll have also a full roundup of some of the political concerns here after Dominic Raab resigned, and a lot of questions also about the CBI, the biggest lobby group here in the UK. The FTSE may be in Italy 0.6% lower. Now, banks, of course, in full swing. Credit Suisse reported first quarter outflows of more than 60 billion Swiss francs. The figure underscores a challenge for UBS in retaining key clients and assets after the emergency takeover of its biggest rival. Now, let's head to Zurich with our colleague, Manus Kranis, who's outside Credit Suisse headquarters in Zurich this morning. Manus, good morning. So what have we learned about these numbers?
Francine. Well, what you have behind me is the potential for flow from here to here. That is the issue. From Credit Suisse, you've seen 47 billion flow out of wealth management. More losses will come. It's not as brutal as everybody thought. The total outflows from assets was 61 billion Swiss francs. Some people had penciled in 100 billion. So the drive-by has not been as brutal as many people had anticipated. But 9% of the wealth management assets have disappeared. Now, Francine, it's important that we disaggregate between deposit flows that have gone out at the touch of a button and assets, real, I suppose, sticky assets. And to that extent, 57% of these outflows, these asset outflows, have been in the forms of deposits. Liquidity, they still needed a liquidity drawdown from the SNB. And there has been a significant write-down in the value of Credit Suisse wealth management overall. This is far from done. And as we've been discussing here in Praterplatz, the fog of war for client assets is far from over.
Yeah, I can hear the noise, Manus. As we all know, we're very familiar with it, of the little machine actually cleaning the streets. UBS will probably have to do a lot of cleaning up also of Credit Suisse. Would they look at the numbers and the outflows and worry about those?
We haven't quite hit that sort of peak worry point. I think to contextualize for you, if 61 billion is the actual number for this month, sort of in that vortex of risk that you and I covered, Citi's great concern is that it could have been 100 billion, and in the case of a much more progressive dissipation from Credit Suisse, you then have a risk on the asset generating fees. I don't think it's at a tipping point, but certainly it's one of the prime issues. It's almost like the Ballon d'Or, putting these two brands together in terms of the assets, the fee generating assets. This institution paid 3.3 billion. UBS paid 3.3 billion to get their hands on 1.2 to 1.3 trillion of Swiss francs over here. So we're not at that worrying point, but of course the job now by Iqbal Khan, Sergio Monti, Colin Kelleher and the team at UBS is to convince those asset owners over here in the family offices to stay the course. Look for a new long-term incentive program. Stay with us. This is about retention of human capital and retention of assets under management. There's a chill wind blowing up and down Praterplatz at the moment. Let's see what the impact finally is. Francine.
Let's see. Manus, great reporting, of course, as ever on the ground. Manus Cranny in Zurich. And then tomorrow, Manus will be putting all the important questions to the UBS Chief Executive Officer, Sergio Armotti. I'm really looking forward to that interview. He'll sit down for an interview in Zurich shortly after the bank reports, 7 a.m. UK time, 2 p.m. in Hong Kong. Now, the Fed's blackout period also begins this week, but hedge funds have already made their final verdict. Sticky inflation is still a problem. Leveraged investors have boosted their net short positions in 10-year Treasury futures to a record high. Now, that's according to data from CFTC, which show an increase for 5 straight weeks. Well, joining us now is Laura Cooper, Senior Investment Strategist at BlackRock. Laura, as always, thank you so much for joining us. Inflation, headline coming down, but actually there's sticky inflation. It's going to be much harder to deal with that.
And that's really been the key story, whether we look at the U.S., whether we look at the U.K., whether we look at Europe, the fact that that core inflation, ex services, continues to be sticky, as you mentioned. And really, it's the key question is how that's going to influence policymakers. In the U.S., I would suspect that they're probably going to be a little more tilted to one more 25 basis point hike and then pause. Whereas if we look in Europe and the U.K., it's really that persistence of sticky inflation that I think is going to be more problematic and probably tilt to further risk, notably coming from the ECB. But as you mentioned in the positioning on the short positions, we do actually suspect that a lot of those rate cuts that are priced in the back half of the year for the Fed are likely have scope to be priced out. And so that's probably going to provide a little bit more of the rates movements in the future.
So where do you want to be invested in this kind of environment?
Well, I think in this environment, if we look at the rate space, it's really still around that short duration, front to the belly end of the curve, whether we look at sovereigns or whether we look at investment grade. We really think that taking that exposure and spreads is really quite an attractive carry opportunity at this point. In the equity space, it's a little bit tricky. We think that earnings estimates for the back half of the year in the U.S. remain too optimistic. We do still see a mild recession ahead. So we are really more selective in our equity positions. And crucially, earnings, I think, will provide some color about the guidance going forward, and that could tilt our positioning in some way.
So I'm a little bit baffled at earnings because so far they're better than expected. So you have a lot of economists, you have the markets worrying also about the unintended consequences of this sudden rise in interest rates in a fast short of time, but actually earnings seem fine.
Well, I think that if we take into the kind of the bigger picture context, the fact that revisions have come down so materially over the past 6 months in the U.S., perhaps the beat rate that we are seeing early in this season is not that surprising. But I think going forward, the fact that earnings estimates are expecting a reacceleration in the second half of the year, at the same time that's likely when we're going to see that U.S. economic deteriorate to such an extent that we are going to see more of those recession fears potentially play out. So those earnings estimates have to be revised. And especially when we look at the kind of the key engine of the U.S. economy, the U.S. consumer, they've largely depleted those savings. That's been the ballast of support. We expect that by mid this year, that's no longer going to be the case. So we are watching the consumer spending quite closely.
Is there anything else that you're watching? I mean, there's so many things out there that are really difficult to model. There's like geopolitics, fragmentation. I don't know whether you have a favorite indicator to look at. I mean, this week I feel it's going to be very busy to try and, make up our minds what happens next.
Well, actually, it's been interesting if we look at, when you talk about indicators, what we're seeing in terms of flows and sentiment, because that's a good gauge for how investors are positioning. And interestingly, we are seeing more of a risk-on turn come through, notably if we look at ETF flows, for example. So in March, we started to see renewed buying in local currency EM debt, some European high yield, and that actually underpins one of our favorite views at this point, which is really that local currency EM debt, because it is quite an attractive carry opportunity. Okay, yes, this is an environment where the U.S. could go into recession. That's our base case. But we think you're being accurately rewarded for taking that risk profile, notably because, as we saw in the China GDP print last week, China reopening continues to be robust. And we do think that's going to be that key pillar of support for the broader EM space.
So, Laura, EM local currency, is it regionally, so neighboring countries, also China, that could benefit from some of the changes there, or you go to a completely different region?
No, we do like broad exposures with the EM, but I mean, if we were to tilt a preference, it would tilt more towards the LATAM space. So whether Mexico, Brazil, largely because if we look at where the rate tightening cycles are there, you are getting quite an attractive yield pickup. So that's probably where our preference lies. But even then, we do still like kind of the broader EM space, largely because even China, for example, having exposure there, yes, geopolitical risks remain a key concern over the medium term. But in the near term, we do think there is still this tactical opportunity potentially to play out in the equity space.
We also had Ifo a little bit better than expected. I mean, nothing huge, but a bit better than expected. How do you play Europe?
I think Europe is quite an interesting story in the sense that we've seen this outperformance of European equities relative to the U.S. for an extended period of time. I believe it's the longest period of outperformance in over a decade. And the key question is that sustainable? We are seeing that PMI prints and services suggest that this is an economy that is recovering from the pandemic restrictions still ongoing. But if we struggle to see that decoupling from the services and the manufacturing as persisting, so we do think the services sector is going to come under pressure. So perhaps some of the sentiment in Europe is unwarranted, the upbeat sentiment. Notably, if we think about the ECB, we had Isabel Schnabel last week come out with a very cautious tone around the inflation outlook, ECB's Lane as well, really signaling that there are some concerns still in Europe. Key will be the bank lending survey, which is forthcoming, and whether that we are seeing more of that tightening in financial conditions from the banking stress. But I think at this point, there's a lot of uncertainty to really take broad outright exposure in European equities.
Laura, thank you so much, as always. Laura Cooper, there, Senior Investment Strategist at BlackRock. Now, coming up, Baltic backlash. Latvia, Lithuania, and Estonia are infuriated by comments made by a Chinese envoy to France. We'll discuss the latest on the diplomatic row in Europe next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Welcome back. Now, the focus is definitely on some of the earnings out there. Philips gaining as they had some pretty strong earnings, and that outweighs some of the settlement cost. Now, the share is rising some 13.8%. I think we have the share price. If we do, we'll show you what it's doing right now. Gaining the most in about 2 decades. Now, Philips surged as stronger than expected earnings outweighed the 575 million euro cost of planned legal settlement related to the company's sleep apnea devices. So we'll have plenty more, of course, on Philips shortly. Now, overall sentiment for markets, it'd be great if we showed you some of the indices out there, but actually European markets a little bit unchanged. They have been declining as traders trim back some of the risk levels before a lot of economic data this week that may help us understand actually the path forward for interest rates. So for the moment, they're either flat or on the down foot a little bit. And then we look at leveraged investors boosting their net short positions on 10-year Treasury futures to a record 1.2 million contracts as of April 18th. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Several nations have ramped up efforts in Sudan to evacuate consular workers and expats from the war-torn country. The UK and US have airlifted their diplomats to safety, while other nations have started to gain access to Khartoum's airport. The World Health Organization says more than 420 people have now died amid intense fighting between Sudan's army and a rival militia. Now, Speaker Kevin McCarthy says the House will pass his plan to increase the U.S. debt ceiling this week. McCarthy's proposal would stave off a debt default for about a year and trim the $4.5 trillion in spending over the next decade. Sources tell us the U.S. House Speaker hasn't yet lined up enough votes, but the effort is making progress. Prime Minister Fumio Kishida's ruling party has narrowly secured wins in 4 or 5 Japanese by-elections held over the weekend. The PM's Liberal Democratic Party kept the 3 seats it previously held and also picked up a 4th. The victories will add to speculation Kishida may call a national election after hosting the G7 summit, which is happening in May. Latest polling says Americans are souring on the prospect of an election rematch between President Biden and the former President Donald Trump. Most of those surveys in the poll for NBC News said that Biden should not seek re-election, while 60% were against Trump taking part. Biden is said to be planning an announcement as early as this week that he'll run for a second term. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Coming up, Germany's business outlook unexpectedly improves. We'll dig into what's driving the rise in optimism next. This is Bloomberg. Now, Germany's business outlook unexpectedly improved for 6 months as the economy gradually recovers from Europe's energy shock. Economists had forecast an expectations gauge by the Ifo Institute to show a small drop. Joining us now is Clemens Fuest. He's president of the Ifo Institute. Clemens, thank you so much for joining us. When you look at the Ifo numbers and the outlook for the German economy, inflation headline could come down, but actually there's a sticky inflation. How much do you worry about that going forward?
I think there are reasons to worry about inflation. Yes, headline numbers are coming down, but what we see is that core inflation is rising in Germany and in the Eurozone. That reflects that the inflation pressure is getting broader. It's going away from energy prices. Energy prices are coming down, but other prices are rising, and we now see wage settlements reacting. So I think overall, yes, it is true that there is hope that inflation will fall, but it may fall very slowly, more slowly than many people hope.
The banking crisis certainly shook a lot of people up in March. Do you worry that there'll be a longer standing legacy of these banking readjustments?
I think what we've seen in the last 2 weeks suggests that maybe the banking crisis is over, at least in Europe. I think in the US the situation is more tricky. But in Europe, it seems like Credit Suisse was a particular case, and there were worries about some other banks, but this seems to have calmed down. It's certainly true that the ECB monetary policy will have an eye on the financial sector and the fundamental problem that interest rates are rising very quickly and putting pressure on the financial sector. This fundamental problem hasn't gone away, but I think at least in the short term, these worries have gone away. So I think we're out of the woods there for the moment.
Mr. Fuest, overall, do you worry, or I don't know what you worry about the most, that now we think we're over the worst in terms of energy crisis and that things get suddenly worse because of an escalation of the war in Ukraine, or is there something that we're underestimating? We saw, for example, today the tensions because of a Chinese diplomat and what that put into question.
I think there is this looming conflict with China. Of course, the Ukraine war, we don't know how that is going. And there is this looming conflict with China. The Chinese economy is recovering. So in the short term, this is a positive force. But in the medium term, the relations to China are unclear. And that's one issue for worries. Also, energy supply in the next winter is an open question. For the moment, we see low gas prices and improvement. But in the coming winter, we may return to higher prices and we may have supply problems. So this energy crisis, there is a pause in this crisis, but the crisis is certainly not over. And then there is, of course, the issue of inflation and monetary policy. How will this strong increase in interest rates affect the European economy and the world economy? It currently looks like we might manage a soft landing, but that is far from clear. We see some sectors where we have a stronger impact, like construction, which is going very bad in Germany. So I think that's another risk that we may end up with a strong dampening of the economy due to these very quickly rising interest rates.
So, Clemens, how are you expecting everything to pan out? Kind of, a stronger trend and then question mark for September?
I think we will continue to see this economy, which is neither collapsing nor growing dynamically. So it's a stagnating economy. And the question is what could take the economy out of stagnation. I think something that could achieve that would be further improvements in supply chains and maybe perspectives for a settlement in the Ukraine war. I think a positive factor is the signal given by the Secretary of the Treasury, Yellen, more cooperation with China, warning that conflicts may go too far.
Thank you so much, Clemens Fuest, there, President of the Ifo Institute. Coming up, the UK Prime Minister will be speaking with top business leaders today. We'll ask what that means for the business lobby. This is Bloomberg. Credit Suisse sees clients pull over 61 billion francs from the bank in its first earnings since the UBS takeover deal. Now we're live in Zurich. European stocks and futures fall before data this week that may illuminate the path forward for interest rates. Treasury yields tick lower, plus the Chinese embassy in France pulls a transcript of an interview in which the ambassador questioned the independence of former Soviet states, remarks that unleashed diplomatic fury across Europe. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Credit Suisse reported enormous first quarter outflows, underscoring the challenge facing UBS as it absorbs its rival. Clients pulled over 60 billion Swiss francs from Credit Suisse during the period when a loss in confidence led to the Swiss government to broker an emergency takeover. Well, let's head to Zurich now with our colleague Manus Krani, who's outside Credit Suisse headquarters in Zurich. So, Manus, what have we learned about the numbers? And good morning.
A very good morning to you, Francine. Well, if you look at UBS's stock price up 1.5%, the market's perception is this could have been a lot worse. What we know is this: 61 billion went from here. We don't know what portion of it went from here to UBS. I've got it the right way around eventually. Credit Suisse behind me there, UBS behind me there. But the bottom line is they say that more pain will come. 9% of the assets went out the door. Now, what we know is the rich have not hung around. A great proportion of the deposits that were removed from Credit Suisse have gone out the door. The question is whether it's a slow dissipation or the beginning of a much bigger glacial move. That's the risk to the UBS Credit Suisse deal. Liquidity. We know that Credit Suisse needed liquidity and will possibly need more. We know that they took a goodwill write-down of 1.3 billion. That gives you a sense of the injury that has been afflicted on the wealth management business within Credit Suisse. The issue is, however, how much of your top talent, those individuals with the keys to the kingdom in terms of the assets of the super rich, the hyper rich, the families around the world and in Asia and here in Switzerland and Europe, to keep those assets under the house of UBS, turn the key and generate assets. That is the challenge for Iqbal Khan, Sergio Amotti and Colm Kelleher. And one of the questions we'll put to Amotti tomorrow morning when we sit down is, what's your story? What's your pitch from UBS to get these clients to stick with you, to generate the magic numbers that the market believes can be done from this transformational Swiss banking deal? Francine.
Manus, as always, great work there on the ground. Manus Krani in Zurich. Now let's also get to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China has approved more new coal power plants in the first 3 months of this year than in all of 2021. According to research by Greenpeace, provincial governments gave the green light to more than 20 gigawatts of new coal capacity in the first quarter. That's as Beijing continues a rapid expansion of fossil fuel generation in an effort effort to guarantee reliable electricity supplies. Now, Speaker Kevin McCarthy says the House will pass his plan to increase the US debt ceiling this week. McCarthy's proposal would stave off a debt default for about a year and trim the $4.5 trillion in spending over the next decade. Sources tell us the US House Speaker hasn't yet lined up enough votes, but the effort is now making some progress. NBC's Universal CEO Jeff Shell is leaving his role after admitting to an inappropriate relationship with an employee. Comcast said it mutually agreed with Shell that he will depart with immediate effect. Shell, who is married, has served as CEO of NBC Universal since January 2020 and worked at his parent company Comcast for almost 2 decades. The firm has not named an immediate successor. That's your Bloomberg Business Flash. Francine.
Thanks so much, Leanne Gerrans. Now, UK Prime Minister Rishi Sunak is set to speak with major firms and investors today. This is as he seeks to fill the void created by the implosion of Britain's main business lobby, the Confederation of British Industry. Now, for more on all of this, let's bring in Bloomberg's politics reporter, Emily Ashton. Emily, good morning. So what's the thinking behind the PM's plans at this point?
So yes, big major talks today. It's called a Business Connect. He's got more than 200 business leaders in London. And the idea, the government says, is to unlock innovation, grow the economy. But as you say, this void has been created by the kind of implosion of this business lobby, the CBI. And that comes after the CBI suspended much of its operations. Dozens of companies have quit. And that follows allegations of rape, sexual misconduct among staff members. Now, all policy is on hold at the CBI until June. And the government's cut its ties with the CBI while that investigation continues. But relations with business have been difficult for the government since Brexit back in 2016, that referendum. Boris Johnson had a rocky relationship with business as well. And we had all that chaos in government last year, which has not helped relations as well. So Rishi Sunak's keen to get on the front foot with business again. And also on the politics side, you see Keir Starmer's Labour Party really make inroads with business in recent months. He's had lots of events kind of wooing business leaders. And I think now Rishi Sunak's government wants to get back in on that.
And Emily, this comes so soon after the resignation of the Deputy Prime Minister Dominic Raab. Has there been any fallout to that within the Conservative Party?
That's right. I mean, Dominic Raab resigned on Friday, and let's not forget he was a key ally of Rishi Sunak. He was his Deputy Prime Minister, came after a report upheld 2 allegations of bullying. And yes, there has been fallout within the Conservative Party. Some in the party, some MPs believe that Rishi Sunak should have defended Dominic Raab, should have stuck with him more than he has. Rishi Sunak said barely anything about it and let Raab kind of fall on his sword and just leave. So expect that to kind of rumble on. But there is that war ongoing between ministers and civil servants within some sections of the party, and that is going to be an ongoing headache for Rishi Sunak.
Yeah, Emily, Labour has its own problems. Veteran Labour MP Diane Abbott has been suspended.
That's right. And yesterday, yes, Diane Abbott suspended as Labour MP. She's obviously been a Labour MP for over 30 years, but she wrote a letter to a newspaper suggesting that Jewish people experience prejudice, but not racism like black people do. Now, she apologised, but the party HQ swiftly removed the whip from her. And now she will be sitting as an independent MP until that whip is restored, if it is. But obviously that's a very difficult subject for Labour. Keir Starmer, the Labour leader, has tried to show he's changed the party by rooting out anti-Semitism after the Equality and Human Rights Commission had put the party in special measures over that. So very difficult topic for that. So we'll see what happens to her with the whip in future weeks.
Emily, thank you so much. Emily Ashton here in London. Now, the guest list of business executives who will be speaking to Rishi Sunak today includes the Barclays Chief Executive, C.S. Venkatrishnan, and we'll be speaking to him exclusively this week on Thursday, and that's after earnings. Many questions, of course, about the business model going forward, but also what the banking turmoil meant for Barclays. Now, sticking with the UK, all eyes will be on bank earnings, starting with Standard Chartered on Wednesday. For more, let's bring in Bloomberg's Markets Today editor, Christine Aquino. So Christine, thank you for joining us. What should we be on the lookout when you look at earnings this week?
Well, Francine, for UK banks specifically, it's really going to be about those deposits, right? I mean, we've just seen Credit Suisse reporting today $69 billion of outflows. I mean, that's staggering. And of course, we know what happened in the first quarter, right? It was a tumultuous quarter, eventually led to the downfall of Credit Suisse. And so investors are very curious to see, has that whole situation really created lasting damage on the banking sector as a whole? And as we know, HSBC, for instance, involved in the rescue of SVB UK as well. And so really just looking at the health of the balance sheets of these banks and looking for signs that they've moved past that turmoil that we see in March.
Christine, when you look at gilts, what are they telling us?
Well, Francine, mixed messages from gilts today. I mean, we did definitely get good news from the S&P outlook revision. They're now seeing it as stable instead of negative. The outlook for the UK debt market, that comes as the impact of Liz Truss's unfunded budget faded away. But, we still have that inflationary story that is very much driving gilts at the moment. We've seen that heat up bets for the Bank of England to raise interest rates, and the bank itself now needing to consider more rate hikes than probably what they wanted initially, because inflation is just proving too stubborn in the UK.
And then pounds. I mean, pounds not doing badly at all. That's probably the understatement of the year.
Exactly. I know. It is the comeback kid of the currency world. I mean, there is still a lot of negative factors, of course, as we mentioned, the inflation story complicating things for the pound moving forward. But I think it is holding up quite well. It's looking quite resilient. You could argue those rate hikes, if they do come to fruition, would be good news for the pound in theory, because, it just raises their appeal for international investors. But I think also there's a dollar story to consider here. There's definitely the feeling that the dollar is past the best parts of its rally, and it is set to pull back a little bit because we're now looking at potential Fed rate cuts that markets are pricing for. That's not the base case yet, but, we are seeing the Fed staff economists, for instance, projecting a mild recession out of the U.S. later this year. So that could be another weight on the or on the dollar, rather, which in turn could be a boost for the pound.
There you go, Christine. Thank you so much. Bloomberg's Christine Aquino here in London. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. London time in our half-an-hour UK special. Coming up, we speak to Mursal Hedayat, Chief Executive of AI-powered online language learning platform Chatterbox. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a new study by Stanford University and MIT researchers show that AI tools boosted worker productivity at a Fortune 500 software firm by 14%. Now, the research found that the lowest skilled customer service workers reaped the greatest benefits when AI was rolled out. Well, joining us now is Chatterbox Chief Executive Officer Mursal Hedayat, Chief Executive of an AI-powered language learning platform that especially helps refugees. So thank you, Mursal, for joining us. Now, I feel like there's a lot of ethical debate on whether AI is a force for good or bad, but 100% in your case, you're using it for good. This is to give language skills for people that need it most.
Definitely. I mean, I think a lot of people are worried about technology and AI in particular taking over jobs. And I think we know from history that that's not always the case. At Chatterbox, we've built technology that uses AI to allow anyone to teach their native languages online. And the power of that is that we can use this technology to employ refugees, women returning to work after a career break. So the social impact is even greater.
So I guess the concern is that it's the first time, and we were in Ireland together at the New Economy Forum, is actually this is the first time when you see a big disruptor, and I keep on hearing like this is, you know, the first time where we had the car. It disrupted, of course, the horses, and a lot of people think, well, what do we do with the horses and what does it mean going forward? But AI doesn't really put the human at the center of it, or does it?
I mean, I think humans are so adaptable, and I think if anything, if some of the more rote parts of work are taken over by technology, that can only be a good thing. I think lots of things that we do today are not fulfilling for human beings. Take language technology, language learning like we do at Chatterbox. So much of the education in teaching grammar and vocabulary is way better suited to multimedia, AI, space repetition, not with the teacher standing in front of a chalkboard. What the teacher needs to do is to engage the learner, keep them motivated, and to help them practice and to give them a real-world practice setting. This is exactly what we do. Now, that wouldn't have been possible if technology hadn't advanced to the level that it has now.
What's the next, I guess, like for some of the things that you use? Are you looking for processors? When you look at research and development, how much better will your product be in 2 years?
Well, we started off as an AI company, and of course we welcome the revolution that's been advanced. I think the case to encourage more and more companies and people to adopt language learning and technology and AI in particular in their workflows, the case has been made almost, I think, by recent advancements. But I think where we need to go next is to be creative about what parts of the economy are truly better off delivered by human beings and which parts are better off delivered by machines, to upskill and to make sure that these opportunities are spread far and wide. I did mention at Chatterbox our recruitment program specifically hires refugees and those who are most marginalized in the labor market. These are not communities that are traditionally engaged in technology or AI. So I think that having foresight into the potential inequalities that may be reproduced, and also thinking about how we can use AI to boost the quality of work overall.
This is so difficult because I don't know whether it's a government or it's private entrepreneurship. If you look at the regulators, a lot are saying, look, they're still on the back foot because they haven't really, we haven't really figured out what AI becomes and what it morphs into. So who's the right person to look into these big questions that you're asking?
I think, I'm a believer in markets. I think that a bunch of driven people like our team at Chatterbox and other places solving small problems, genuine real-life problems for consumers, that is where the real test of this technology and where its impact will be felt. And I really believe in the organic creation of the new paradigm through the markets, but also, of course, carefully guided by policymakers, because we do know there's a dark side to AI, surveillance, biased algorithms that do need to be carefully watched. But overall, I believe in the power of human ingenuity to take this technology to make it truly impactful.
Marissa, how big are you expecting Chatterbox to be? So if you look at the next 2 years, 4 years, 5 years, how are you expecting it to develop?
Well, EdTech has been one of the earliest adopters of AI and technology in general. So I think we're quite far ahead compared to other industries. The language learning industry is over $300 billion in size. The technology segment of it is only $5 or $6 billion, so there's a huge amount of growth. You've seen so many of our language technology companies being listed, being sold, being resold. So I think there are plenty of space for more giants like Duolingo, and I think Chatterbox will be one in the next few years.
Are you getting enough funding? And one of the things that we were also trying to explore is when you look at, 2 years ago, it was all about the metaverse. Now it's all about AI. Now you started the company, or certainly you were looking at Chatterbox before this kind of, general freak out or interest in AI. But has it helped with funding?
We're extremely fortunate to have what's called a double bottom line business model. We are profit making. We have some of the most influential VC backers from the UK and Silicon Valley as our investors, but we also have some of the most influential social impact investors in our cap table. So, funding, it's always a challenge, but I wouldn't say it's been easier for Chatterbox compared to some other social impact organizations. Of course, looking at SVB, looking at recent returns and reports from some of the bigger technology companies, I think the next year is going to be difficult for us. But actually, if you're a company that has strong fundamentals like ours, I think it's a good time to be alive.
So do you need, is there something that you would need more from governments maybe? You're already having a big impact. This is about, training and hiring people that maybe the government may have not thought about. What could what could they do to make your life easier?
Absolutely. I think, being an entrepreneur, you try to predict what the problems will be in 5 or 10 years' time, not the problem that's the problem now. And, 6 years ago when I started Chatterbox, the biggest problems in the horizon were escalating global forced displacement. escalating and accelerating technological displacement from work. And also the opportunities inherent in AI. These are the insights that led to the initial development of the Chatterbox technology platform. Today, I think we're uniquely positioned to help governments solve some of the early frictional and actually structural unemployment that can result, that takes extremely talented people out of work. And we're a great example of how technology can be used intelligently to solve unemployment rather than create it. So in terms of the, we work quite closely with the government in the UK. It would be great to partner with governments elsewhere to see how we can support more people worldwide.
Mursal, thank you so much for joining us.
Thank you for having me,
Chatterbox Chief Executive Officer Mursal Hedayat. Coming up, as we get a slew of European bank earnings this week, we'll discuss what investors will be watching out for. That's next, and this is Bloomberg.
The medium-term trend is for a very aggressive weakening in the U.S. dollar because we unwind the stagflation trade of last year.
I do think it is a time for dollar weakness. We could be seeing the Fed peaking a bit earlier than other central banks, which means there are better yields to be had for that level of safety elsewhere.
Is it that a slowing down U.S. economy is necessarily going to be supported for the dollar? Or is it that because people are coming back to U.S. Treasuries, that inflow actually makes a difference?
The strong dollar had been a headwind for emerging markets. Our view is that it likely does weaken from here because the U.S., in terms of interest rate hikes, likely one and done in May.
I don't really believe that the dollar can really weaken significantly. Certainly, I think it's going to be choppy. There's going to be bouts and risk appetite appears better. But I think we're in for perhaps a rocky ride still for the rest of this year.
Some of our guests there sharing their views on the dollar. Now, that's the subject of the latest MLive pulse survey, which shows investors see the greenback sliding even further from last year's two-decade high as the market has underpriced the Fed's oncoming easing cycle. Now, more than a third of respondents actually expect the dollar index to fall by between 2% and 5%. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Several nations have ramped up efforts in Sudan to evacuate consular workers and expats from the war-torn country. The UK and US have airlifted their diplomats to safety, while other nations have started to gain access to Khartoum's airport. The World Health Organization says more than 420 people have died amid intense fighting between Sudan's army and rival militia. Now, Speaker Kevin McCarthy says the House will pass his plan to increase the U.S. debt ceiling this week. McCarthy's proposal would stave off a debt default for about a year and trim $4.5 trillion in spending over the next decade. Sources tell us the U.S. House Speaker hasn't yet lined up enough votes, but the effort is making progress. Prime Minister Fumio Kishida's ruling party has narrowly secured wins in 4 of 5 Japanese by-elections held over the weekend. The PM's Liberal Democratic Party kept the 3 seats it previously held and also picked up a 4th. The victories will add to speculation Kishida may call a national election after hosting the G7 summit, which is happening in May. Global news powered by more than 2,700 journalists. Francine.
Leanne, thank you so much. More Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Anna Edwards. This is Bloomberg.
We're going through reporting season at the moment, and I think that's probably going to be key, isn't it? The outlook from companies, the types of the sort of earnings numbers that they come up with, and their outlooks going forward.
Growth continues to slow, and that continues to pressure profits and put us further into this earnings recession that we've already been in.
There's just a lot of great news priced into great companies right now. If you feel safe owning it, it's probably expensive.
This is ultimately really going to be, I think, a defining earnings season for winners and losers.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. UBS has its work cut out for it. Credit Suisse saw $69 billion of outflows in a frantic first quarter and took a large write-down at its wealth management unit. Big week for earnings. We will hear from the tech giants Amazon, Meta, and Microsoft, plus regional banks such as First Republic. And hedge funds appear confident the US can avoid a recession. They've placed their biggest ever short on 10-year Treasury futures. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, perhaps today, one of the quieter days, for now at least, as we get ready for what could be a really busy week on the earnings front and also on the macro.
Yeah, I mean, I was expecting us to break out of this tight trading range on Friday after the options expiry, but a whole lot of nothing ended up happening in the cash trade. We closed at 41.33, I think like 0.1% higher on the S&P 500. We do see futures down a bit today, about 0.4% for now. So maybe we move out of this range as we start to get more and more earnings, deeper into reporting season. You see the 10-year yield coming down. I think this is a really interesting story on hedge funds being very short, especially the leverage funds being very short treasuries. Right now, it looks like investors are buying treasuries, and that's pushing the yield down about 3.5 basis points to 35.53, I should say, which really isn't much different from the range that we saw last week. It's pretty much exactly where it was on Friday at this time. NYMEX crude also not moving at all. Since it moved down into this range, it's been stuck there. So we'll see what happens at 77, 76 if OPEC plus countries start to actually cut production. Remember, we got those surprise cut announcements, I think now 3 weeks ago on a Sunday, and it didn't do anything really to boost the price. Bitcoin is down again today, $290 to 27,221. So it looks like investors continue to take profits after we breach the 30,000 level to the upside. In terms of what's going on in Asia, a little bit of a mixed picture, but also not huge moves. The broader MSCI Asia Pacific Index is down 0.2%. You had gains in Japan slightly at the close. The Nikkei was up 0.1%. The Hang Seng was down 0.6%. And you do see a little bit of U.S. dollar strength. This is interesting because a lot of people are looking at major currency pairs and expecting the dollar to weaken. But right now we see dollar strength again against the yen. You can buy more than 134 yen for a U.S. dollar. Anna, what do you see in Europe?
Yeah, we see weakness in Europe. And on FX, we'll get a lot more analysis on the FX market later in the programme, won't we, Matt? But this is the European picture right now. Quite a lot of divergence, actually. The Italian market really underperforms, down by just over 1%. Elsewhere, we see much more modest losses coming through. And in fact, some of these markets not going very far this morning. The FTSE, the CAC 40 and the DAX all down by around 0.2%. If we have a look at where we see movement, financial services is, of course, an area of focus for us this week. We get lots of earnings out from Europe. And we started with Credit Suisse earnings, but let's face it, we know how much Credit Suisse is worth right now because they're being bought by UBS. So I put the UBS share price in here on the back of those Credit Suisse outflows, and we'll get some further analysis from Zurich on that subject in a moment. But the UBS share price up by 1.9%. Philips is really in focus. This is the Dutch healthcare business, up by 11%. There were the earnings and also a focus on cost reduction, and that seemed to really delight the market, despite the fact that they had to make a big legal cost, take a hit on the legal cost, I should say, because of the controversy and difficulties, the legal challenges they face around their sleep apnea products. But as a result, the stock is net very positive. The euro in focus at 110, just over that 110 level. It's a busy week for macro. We'll get inflation data out towards the end of the week from lots of European countries, so that'll be a focus for us. Also, we'll keep an eye on the euro-yen with the BOJ meeting later on this week. And the pound also in focus. As we're going to talk FX later in the programme, I thought I'd put in some FX. And we had, after the close on Friday, an upgrade to the outlook from the S&P on the UK economy. They took that from negative to stable, so that on the back of a lot of people rethinking their assessments about whether we go into a recession, or if so, how deep here in the UK. So the pound up a touch on the back of that story.
Sleep apnea products. What, that's like the mask that with the tubes? That's the... that what you're talking about?
I have to say, I'm not entirely sure what they look like, but they led to some legal challenges.
All right, well, it's lucky that you don't know because it looks very uncomfortable. Let's get to the banking story in Zurich right now. Credit Suisse reporting $69 billion of outflows in the first quarter. The figure underscores the challenge for UBS in retaining key clients and assets after the forced takeover by its bigger rival. Manus Cranny joins us now from Zurich. So, Manus, what have we learned about these numbers?
We've learned that it's a brutal flesh wound in terms of the exodus of funds, assets under management from this brand, Credit Suisse. The question is, how much did this brand, UBS, garner from those outflows? A question that we will discover more tomorrow morning. But it is a brutal flesh wound. But what it could have been, an awful lot worse. A lot of people out there are saying it could have been 100 billion Swiss francs that left the front doors of Credit Suisse. They have said things are going to get worse. We're going to lose money, substantial amounts of money. Credit Suisse's message to the market, this fog of war, as it were, on deposits, on confidence, is far from done. So 60 billion went out the door. And by the way, the rich don't hang around, do they? Deposits went like that. 57% of these outflows were deposits that can be done at the touch of a button. The challenge now is how do you convince your clients to stay? Liquidity, they drew down 100 billion. Credit Suisse drew down 108 billion in liquidity from the central bank. And to understand the dissipation in terms of wealth management, they took a write-down of 1.3 billion Swiss francs. There is no declaration of victory here, but Anna, you're bang on the money. UBS's trading price is a vicarious interpretation, far more intelligent than mine, in terms of the first take on Credit Suisse's numbers and what it means for the future of the deal.
Yeah, absolutely. And what does it mean for UBS then, Manus, as Credit Suisse scrambles to try and keep the dollars and keep the people in the door? What does it mean for the business that is buying Credit Suisse?
I think Hildebrand in Dublin at the New Economy Forum summed it up beautifully, where he said Philip Hildebrand, you know, one of those core individuals of Swiss banking, we understand, was deeply involved in this, in perhaps the negotiations around this. It's about integration risk. And here's the thing. When rich clients, and I've had a few, promise you that they're going to come with you. They're going to come with you to the hallowed ground. They're going to come with you to the new institution, and then they don't. They're sticky. They stay where they are, where they have had decades of relationships. You know, the road to hell is paved with great intentions by super wealthy clients. They promise you a great deal, and then they go, you know what, it's not just so bad here. I'm getting a much better rate of interest. So I think it is about Iqbal Khan, Colin Kelleher, and Sergio Motti confirming and affirming to the anointed ones within Credit Suisse, stay with us, stay the course, stay the road. We will give you the long-term incentive program to remain with us, because they are the keys to the kingdom. Those rainmakers who look after the families of the super rich and the institutions. Convince them to stay, and this will be, quite literally, le ballon d'or for Motti and Kelleher. The risk is further slow dissipation of assets, fee-generating assets, is the single biggest risk in this trade.
All right, Manus, amazing reporting. As usual. Great to have you there in Zurich. Manus Cranny joining us from the capital of Swiss banking, a universe that just seems to continue to get smaller and smaller. And it's not just European bank earnings. This week brings an avalanche of earnings from a number of sectors, tech to industrials. Simone Foxman joins us now on set here in New York for more on what to expect. So what do we got lined up for this week, Simone?
Well, $16 trillion worth of earnings from companies within the S&P 500. That makes it its busiest week, at least by a market cap basis. One of the key themes we're looking at is tech. Analysts are expecting the biggest drop in profits since 2009, and we're going to see those major names report. Alphabet, Meta, Amazon, Microsoft, all coming in this week. The story I'm really watching, however, is the consumer. We saw Procter & Gamble come out late on Friday, boosting its sales expectation, but on the back of higher costs. We're also going to see Coca-Cola, McDonald's, PepsiCo, Kimberly-Clark, UPS, all of these giving some indication of how the consumer is really faring. And then we'll get, towards the end of the week, round out those earnings with some oil super majors, Chevron and Exxon.
Okay, so plenty to look out for, Simone. Bloomberg Intelligence says some 77% of the S&P 500 companies that have reported so far have beaten expectations. What do analysts more broadly make of the earnings story?
Yeah, well, that number is really a question that Mike Lowengarten at Morgan Stanley asked. Were these expectations intentionally set too low so that these executives could come out and say, hey, we actually did better than what we were projecting and where everybody thought we were? But there are a couple of reasons that analysts might have kind of gotten this wrong and had expectations that were a little bit too low. One, we're already in an earnings recession, and we really have been since the second quarter of 2022, if we define that as 2 consecutive quarters of profits being below their year earlier level. You know, the second one, and I think this is why I'm so interested in the consumer piece as well, is that some of the concerns we're seeing in the market are not based around banking stress. They're not things that we see so closely here in New York City or in London. They're really issues with the broader economy. So trucking, the amount of freight being carried in the United States, slowing down. Or Procter & Gamble, I mentioned that they boosted expectations for sales, but that's on the back mainly of some higher costs. So input prices rising. And these things are just harder to kind of put that specific figure on. And so, yes, we are seeing all this kind of wariness about the expectations for earnings, but maybe it's just harder to kind of get a grip of what that actually does to the numbers and when, of course, that's going to play out.
And also, 76% of companies beat S&P 500 earnings expectations every quarter since I was a little kid, and I'm old.
Well, I mean, it's the messaging, right? You're trying to set this up.
It's always exactly. 76, 77, 75%. It's always in that range. So nothing's changed in that sense. Simone, thanks so much. Simone Foxman there reporting on a lot of earnings to expect this quarter. EVTS on your Bloomberg terminal is the best way to find the earnings calendar. Let's get to hedge funds right now. They seem to be confident as the Fed as confident, I should say, as the Fed that the U.S. economy can avoid a recession despite the burden of higher interest rates. CFTC data shows investors boosted their net shorts on 10-year Treasury futures to a record 1.29 million contracts as of April 18th. Bloomberg's Valerie Teitel joins us for more. So, Valerie, what do we know about shorting Treasuries?
Look, there's 2 things notable about the CFTC positioning data that came out on Friday. One of them being the most net shorts on that 10-year bond on record. But the second one being is that their shorts were across the curve as well. 2-year futures, 5-year futures, 10-year futures, and 30-year futures all had net short positioning from the hedge fund community. It could suggest that we could be very ripe for a ferocious rally if yields don't continue to creep higher. But it's also prudent to ask, why possibly are they positioning short? Well, let's look at the calendar. What we have this week, we have U.S. GDP, the first advanced reading of the first quarter on Thursday, followed by the Fed's favorite measure of inflation, the PCE metric on Friday. Perhaps the hedge fund community is positioning for a very upside reading on GDP and perhaps a hot PCE number, posing a big question about this Fed pause in May, leading yields to run higher. But I want to caveat that with one thing, Matt, and we need to remember that hedge funds use Treasury futures not just for directional plays, but also for RV trading as well. We know that vol has been declining significantly in the last 6 months. Perhaps this is just suggesting there is a build of a major RV trade in the 10-year part of the curve.
Okay, so that's some of the thing we need to keep an eye on. So that's positioning around Treasuries from the hedge fund community. Valerie, what about their positioning in stocks?
Positioning in stocks, the bears continue to reload on their shorts in the S&P 500. This has been happening for quite a few weeks now. It's now the most stretch in 12 years. Again, suggests if we continue to get these earnings beats, especially from those tech names, that we could see quite a big rally as these shorts get stopped out. We have Microsoft, Amazon, Meta reporting this week. And this also comes as the S&P has seen vol declining as well. Vol has been declining across the board, leading to such a substantial buildup of these positions.
All right, Valerie, thanks very much. Bloomberg's Valerie Teitel talking to us about market positioning vis-a-vis treasuries. Right now, let's take a look at some of the stocks that we're watching in the pre-market this morning. Not a heck of a lot going on and not all massively important companies, but I thought it was interesting to throw in Bed Bath & Beyond. Someone is still betting that this won't go to zero, apparently. Fewer and fewer people after they filed for bankruptcy this weekend. Chapter 11 proceedings will start. Plans to wind down the company by the end of June, and the stock is trading in the pre-market for 18 cents a share. So I guess if you're one of the apes on Wall Street bets, now's the time to buy. In terms of Tesla, we've seen a lot of volatility in this stock due to price cuts and price increases. Bloomberg News' Sean O'Kane and Craig Trudell have a great story on the terminal about Elon Musk's bet on driverless cars. The billionaire said last week that he could drop margins on Tesla car sales to zero, but make up profits on autonomous software sales instead, which is a cool idea, but investors may not love it. This share's down a little more than 1% in the pre-market. Anna?
Okay, lots to focus on then pre-market. Coming up on the program, Maria Weitmaner joins us, senior multi-asset strategist at State Street Global Markets. What does she make of the positioning of the hedge fund community, and what does that tell us about any sort of natural bias in markets as to how we respond to earnings stories? There are certainly plenty of those. And James Lord joins us, Morgan Stanley's global head of FX and EM strategy. We'll get his take on the dollar. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York. Anna Edwards with us out of London. Now, a lot of people have been complaining about the VIX. It's broken. It doesn't work anymore. My buddy Anthony at Cabrera Capital always tells me, well, lately has been telling me he uses 0 days to expiry options instead, and a lot of other people do. So now we have kind of a new VIX coming out today. VIX 1D index is the index. I'm waiting for it to really kick in. But I have a chart here that just shows you the dominance of 0 days to expiry options. This is in terms of total call or total put volume. They've got 18 or 12 to 13% respectively. If you look at just S&P 500 options, 0 days to expiry options make up 40% or more than 40% of that entire universe. So it's huge right now. Joining us is Simon White, Bloomberg's macro strategist, to talk about what to expect. Simon, are we going to get a real volatility index or a real gauge of sentiment of fear with this new VIX 1D index?
Well, I think it's certainly going to make things a lot more transparent. You know, amidst all the kind of excitement of the banking crisis, I think 0 day, trading kind of got a little bit forgotten about, but it's still there. I mean, you go and look at the most active traded options, almost all of them are, either 1 or 0 days to expiry. So it's a huge part of the market. And to say two things I think you've got to bear in mind. One, it increases leverage because to trade 0 day options, you don't need to post margin. And second of all, as you alluded to, the VIX basically becomes or has become a lot less representative of what's actually going on. A good analogy is, if you imagine like a pot of almost boiling water, the surface is very calm, but underneath it's very turbulent. And the turbulent part is kind of like the 0 day trading, and the surface is the VIX.
And
it's
another
not really...
metaphor I know you've used, Simon, is ducks.
Yeah.
Very ferociously underneath the surface.
Always water related.
They're always water related.
Yeah.
I mean, how do we need to be worried about those ducks' feet and that volatility or perhaps instability that could be caused?
Well, I think when you take two things together, when you have a lot of, as I say, extra leverage being taken, and you have a lot of people pursuing the same sort of trading strategies, they tend to chase volatility lower. We saw that in 2018, which means that people have to take on more risk. And if you combine more leverage with more risk, it tends not to end well. Now, I'm not saying it's an immediate risk, but 100% you want to add your 1 day VIX to your kind of screen of things to watch, because it's very much a part of the risk pattern out there.
Yeah, put that in the dashboard. Okay, Simon, thanks very much. Bloomberg Simon White with the latest on volatility, where we see it, where we don't. For more market analysis, MLIV Go is the function to use on your Bloomberg terminal. That'll get you to the Markets Live blog. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. House Speaker Kevin McCarthy says the chamber will pass his $1.5 trillion debt ceiling increase this week. Still, Bloomberg has learned that McCarthy hasn't yet lined up all the votes he needs. He told Fox that President Biden must negotiate in order to avoid a U.S. default. Last week, the president called the Republican plan wacko. Another blow to France's President Macron and his push to enlist China to help in the war on Ukraine. China's ambassador in France told French TV that the former Soviet states don't have a sovereign status as independent nations, aren't recognized as such. Those comments triggered furious reaction, especially, obviously, in former Soviet bloc countries, Estonia, Latvia, and Lithuania. China, though, has now backtracked and says it respects the independence of those countries. And in Sudan, the international effort to evacuate diplomats and other expatriates picked up over the weekend. The U.S. and UK militaries were able to airlift their officials to safety. A temporary ceasefire between Sudan's army and the Rapid Support Forces militia, as it has battled since April 15th, appears to have failed. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. UBS has its work cut out for it. Credit Suisse saw $69 billion of outflows in a frantic first quarter and took a large write-down at its wealth management unit. Big week for earnings. We will hear from tech giants Amazon, Meta and Microsoft, plus regional banks such as First Republic. And hedge funds appear confident the US can avoid a recession. They've placed their biggest ever short on 10-year Treasury futures. I'm Anna Edwards in London with Matt Miller in New York. And Matt, European stocks a little lackluster this morning. US stocks, well, the futures look weaker, but maybe off their lows. A slow start to what could be quite a hectic week by the end.
Yeah, absolutely, because we have so much coming out in terms of earnings, right? And because it seems as if, at least to some extent, investors have shifted their focus to how companies do, how earnings do, away from what the Fed is going to do, although, of course, that'll change next week. Take a look at S&P futures right now, down about 0.2%. Not a lot of movement, and we're still on track for the tightest trading range in a month since 2017. There just hasn't been a heck of a lot of movement in April, which I guess is fine if you're long stocks, right? Because the S&P is still up about 8% year to date. The U.S. 10-year yield comes down just a little, 3 basis points to 353, 354, essentially at the same level as we saw for the last few trading sessions. The same is true of NYMEX crude. 77.69, just sort of hovering here until we start to feel the effects maybe of the production cuts from OPEC Plus or demand picks up from the reopening in China. Bitcoin right now down another $200 and change, down to below 28,000, 27,287. So a little bit more profit taking, it looks like, from crypto investors after Bitcoin peaked above $30,000 in the most recent run up. Take a look at some movers. They're not a heck of a lot pre-market, but maybe because we're waiting for so much in terms of earnings today. Coca-Cola, I believe. Wait, what day is it? Is it the 24th? It's the 24th, right? Coca-Cola out before the bell today. Bed Bath & Beyond is one that, I mean, this company has been left for dead on a few different occasions and then come back like a zombie. But now they have actually filed for Chapter 11 bankruptcy over the weekend. They say they have plans to wind down by June. If you have any coupons, be sure to turn them in by April 26th because they won't honor them after that at Bed Bath & Beyond. 18 cents a share in the pre-market. Tesla down another 1%. Of course, there was a little bit of a roller coaster last week because of cutting prices and then raising prices on two very different model groups. Nonetheless, that seems to be driving sentiment, and Craig Trudell and Sean O'Kane have a great story out on Bloomberg News about the fact that Musk essentially says he could wipe away his margins to zero on car sales because he can make money on over-the-air software updates for autonomous driving. And then, you know, Stellantis is just seemed to have a lot of volatility lately. It's down 6.7% in the pre-market. Now, could be incredibly thin volume. It is incredibly thin volume, but we've just seen a really high beta on this stock, and I think it's interesting. They make Maseratis, Fiats, Chrysler, Dodge, a whole host of brands after the combination of Peugeot Citroën with FCA, and we're just seeing a lot of movement, so I thought I'd draw attention to it. Also, I'm still waiting for my Dodge Challenger, which I ordered a few months ago, Anna.
Yeah, thank you, Matt, for that look at the movers and some public service announcements within there as well. In terms of the auto sector, we saw a lot of movement, didn't we, on the back of the Tesla numbers last week, and we'll keep an eye on that sector. As you rightly point out, there's some movement there, Matt. Broadly, we're not seeing any movement across European stocks today. We're entirely flat, so giving up some of the losses of earlier on, which is perhaps good news at the margin if you're long of stocks. So we're flat on entirely unchanged on stocks here in Europe. UBS is not flat, though. One sector that is going higher is financial services. And that, of course, includes Credit Suisse, but we know what Credit Suisse is worth. We got the numbers from them today. And who does that matter to? Well, really, it matters to shareholders in UBS. And so the UBS share price going higher is an interesting indicator there on the market's assessment of those Credit Suisse outflows and write-downs. The stock up by 1.9%. We'll hear from UBS tomorrow. Philips in focus, that healthcare business in the Netherlands, up by more than 12%. Pleasing the market, it seems, with the numbers. Also, some of the cost-cutting, that offsets concerns around legal costs that they have to incur there. And the pound is up just 0.2%. We saw S&P deciding to take the outlook from negative to stable. That happened on Friday, just after the close, so that having a bit of an impact, perhaps. A lot of macro data due at the end of the week from here in Europe, and plenty of earnings before we get to that, Matt.
You know, let's talk about that macro data versus earnings right now with Maria Feitmana, senior multi-asset strategist over at State Street. Maria, it does feel like the market is poised to pay attention to earnings and not so worried about, you know, the Fed, rate hikes, inflation, et cetera. Do I get the right feeling for this week? Are we worried a little bit less about the macro for now?
Yeah, absolutely. I mean, to be honest, we've been waiting for a week like that for, I don't know, since the start of the year, because last year was all about Fed, right? So it was, for equity market, what driven equity market was multiple compression. So we were waiting for, okay, what's the next thing? And now we're getting into the world where, okay, we're getting close to peak in Fed hiking cycle. We potentially, I mean, we're very likely going into recession. So let's look at companies, which companies can defend their margins better, can sustain some profitability or see less earnings decline. So it's really about earnings. And I think that's great news for kind of equity investors, like top-down analysts, so we can actually do things we like doing, and it matters.
Maria, good morning. Can I ask you about hedge fund positioning or positioning generally and what that where that takes us? Because I was interested today in these stories we've been covering here at Bloomberg. Hedge funds short 10-year treasuries. That might lead to a conclusion that they see better times ahead for the US economy. But then also short stocks. The most they've been short stocks on the S&P, at least, in the past 12 years, which could be a sort of opposite interpretation. Maybe these are different hedge funds. But what do you take away from this kind of positioning conversation?
I mean, first of all, kind of commenting on hedge fund, I think that's basically saying there is a massive degree of uncertainties. So on one hand, you expect recession, on the other, it's not. So that's kind of the first point. But the second point, probably more important, is like when we look at institutional investors' positioning, we see very similar kind of level of uncertainty. Yes, investors are increasing allocation to cash, but not significantly. So yes, they're worried about recession, but it's quite recent, and I think the kind of earnings season would be very important kind of catalyst in that earnings are really falling, and that would be kind of indication of recession, and then we'll see bigger reallocation of positioning.
Okay, so yeah, so a lot of uncertainty out there. We'll wait for more clues from the earnings story. We're going to start to hear from the big European industrials, consumer giants, Maria. What kind of messages are you looking out for from these type of businesses?
I think for us it's really important to see the guidance. And it's really interesting, particularly in Europe, but I mean, it's true in US, but more so in Europe, that consensus expect some weakness in the kind of first half of this year and then recover in the second half of the year. To us, that's kind of really difficult to square up with what fixed income market is expecting, which is kind of, okay, we're more likely to go into recession. We have like inverted yield curve. We're expecting Fed to start cutting rates. So that's very, very inconsistent with what equity analysts are expecting as earnings recover in the second half of the year. So industrial companies...
Wait, you expect the Fed to start cutting rates?
Sorry?
Did you say you expect the Fed to start cutting rates?
No, fixed income market is expecting like futures pricing rate cuts.
Oh, right, on work.
I would be very surprised that if that happens, given economies still kind of we see quite a lot of inflation there.
Yeah, I wanted to ask you about that. So we have the Fed meeting. What is it already next week? Is this the last hike that you expect from the Fed, 25 basis points and pause? Or do you think there could be a couple more? And also, pause for the rest of the year? Do you think we're going to see cuts in 23 or not until 2024?
Yeah, I would say, I mean, the first thing to say is that what we see in inflation, particularly in service inflation, is still quite sticky. So we are not in the world where inflation just gone away. So I think the conversation about cuts, that's completely premature. Cuts this year is completely premature. And I would not be surprised that after we have a hike next week, we begin to look at the we will continue to look at the data and see that actually it is still quite strong. We might need another one. So I'm in much more hawkish camp than perhaps consensus is.
Maria, thank you very much. Thanks for joining us. Maria Wakeman from State Street with us to talk about stocks. We'll talk FX next. Coming up, James Lord, Morgan Stanley Global Head of FX and EM Strategy, joins us. Does he have a similar view on the outlook for the Fed? What does that mean for his dollar call? And where does that leave emerging market FX? This is Bloomberg.
The medium-term trend is for a very aggressive weakening in the U.S. dollar because we unwind the stagflation trade of last year.
I do think it is a time for dollar weakness. We could be seeing the Fed peaking a bit earlier than other central banks, which means there are better yields to be had for that level of safety elsewhere.
Is it that a slowing down U.S. economy is necessarily going to be supported for the dollar? Or is it that because people are coming back to U.S. Treasuries, that inflow actually makes a difference?
The strong dollar had been a headwind for emerging markets. Our view is that it likely does weaken from here because the U.S., in terms of interest rate hikes, likely one and done in May.
I don't really believe that the dollar can really weaken significantly. Certainly, I think it's going to be choppy. There's going to be bouts and risk appetite appears better. But I think we're in for perhaps a rocky ride still for the rest of this year.
A few of our guests there discussing their outlook on the greenback. According to the latest MLive Pulse survey, investors see the dollar sliding even further from last year's two-decade highs. Joining us now is James Lord, Morgan Stanley Global Head of FX and EM Strategy. And James, you know, it's really interesting. We saw the Bloomberg Dollar Index rise to 1350 and change at the end of last year. We're now down to let's see, 1224, if I'm seeing this correctly. How much farther do you think it could fall if you're bearish the dollar?
So we take a slightly different view on the dollar to, I think, the general sentiment that you were just showing on your last clip there. Like, we've actually turned bullish on the dollar. So we're moving in the other direction. We actually think that euro dollar can head back down to, say, 103. The Dixie can test the highs that we saw back in the beginning of March. We think that the consensus is a little bit offside on this one. We can certainly see the positioning has built up to become quite short the dollar. And we think this is a good time to be moving tactically in the other direction.
So where do you think the best gainers are or the best losers are against the dollar? I mean, if you think it's going to appreciate against which currencies the most?
Yeah, so euro is one, as I mentioned, and then within the EM context, we like dollar against short Chilean peso. But the overall dollar thesis that we have is very much that the market is underpricing the risks of a US slowdown, but also importantly, underpricing the risks of that slowdown spilling over into the rest of the world. I mean, I think US economy is clearly quite weak at the moment, and the market sort of narrative around that is that the weakness will be sort of isolated to the US economy. But no economy is an island. As the US economy slows, it will increasingly spill over into the rest of the world. And I think that's the bit that the market is sort of missing at the moment. We're sort of in this phase where the market is increasingly seeing the US slowdown, but is treating it as a sort of isolated event. And I think that's what we really want to push back on. The Eurozone economy... Yeah, go
Sorry,
ahead.
James, I was going to say, and you think that would be positive for the dollar then? So a slowdown in the US, and what, because of haven status? Is that the thing that wins out against the other currencies?
Exactly, yeah. So you get a little bit of safe haven demand for the dollar that pushes the dollar up. But crucially, you get the market to question the growth in the rest of the world. So at the moment, for example, you see ECB pricing of rate hikes moving up quickly, like more, and you're starting to see 75 basis points of rate hikes being priced in for the ECB, with just one for the US before some easing cycle starts later in the year. That kind of divergence may get called into question if the US economy slows down even further, and people will start to reassess their outlook for the Eurozone. Right now, the Eurozone is sort of stagnating in terms of its economic activity. But an external shock, like a slowdown in the US, I think would tip the risks more towards a slower economy in the second half of the year.
Okay, I want to ask you about the pound, James, as well, because we saw after hours on Friday, we saw the S&P deciding to upgrade the outlook to stable from negative. There do seem to have been quite a few people rethinking where the UK economy goes, and I wonder how that translates into the pound for you.
We have a neutral view on the pound at the moment. We don't have a formal recommendation in terms of an outright trade, certainly against the dollar. I mean, I would say that if we're right on our dollar call and euro dollar heads down, I would expect cable to come under a little bit of pressure. But yeah, I mean, there's no denying that the outlook for the UK has improved a little bit compared to what we saw through the sort of final months of 2022. But very much the growth outlook is weak, and with the current account deficit and a lot of external financing needs, I think cable would probably head lower if we were right on our broader dollar call.
What about the yen, James? I mean, especially if UATA comes in and makes changes. I know they're not expected so soon, but over the longer term, where do you see the yen going against the dollar?
Yeah, so we actually have a short dollar yen view at the moment. So this is the only place where we do have a short dollar position. And we would expect the yen in the global scenario that we're expecting, where global growth fears increase, we would expect yen to benefit from safe haven demand as well. So it's very much linked to the kind of broader narrative that we have on FX markets. But clearly, this having a short dollar yen position on does give you a little bit of exposure to the possibility that something happens with BOJ this week. I mean, we're not expecting any tweak to yield curve control at this meeting, but we put a sort of subjective probability of maybe 20% that you could see an early move. And yeah, I mean, if that does come through and there is an exit from YCC over subsequent months, yeah, this should be something that puts a little bit of downward pressure on dollar yen. I mean, the argument for them to do it in this meeting is really because nobody's expecting it, right? I mean, the market pricing is, markets are quite stable. Nobody's really testing YCC at the moment. So, they have flexibility to kind of make a tweak this time. But, UAE's been quite clear. They're not really thinking about doing it. So that is our base case for this meeting.
Okay, yeah. Thanks, James. He's also been quite clear about the value of surprise, though, to your other point. James Lord, thank you very much joining us there from Morgan Stanley with his thoughts on FX markets. James was talking there in passing about the Eurozone economy stagnating. What has not been stagnating is the market cap of some of the big luxury names in Europe. LVMH, the market value there, the luxury business based in Paris, hitting $500 billion. That's the first time a European listed company has achieved that kind of market capitalization. So an incredible achievement. You could still fit 5 of them into an Apple, of course, but that's the European record right now. Coming up on the programme, First Republic is out with earnings after the bell today. We'll be back to the bank earnings story. We'll get a preview next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, U.S. regional banks continue to report earnings today, with First Republic reporting after the closing bell. Investors are going to be watching, obviously, for deposit flows and funding cost expectations. Sonali Basak, our tireless global finance correspondent, joins us now in the studio for a preview. So this is one that we've all been watching, including Jamie Dimon, right?
Yeah, everybody's been watching it. Jamie Dimon, Bank of America, and it's because they had just flooded this bank with $30 billion worth of deposits coming from the biggest banks in the United States. Now, the pressure on the deposits, of course, is the main story here. It's First Republic out of the woods here. But then there's that secondary problem, and we've seen it with all of the other regional banks. How much is their business itself under pressure with that pressure on deposits? Even if things have stabilized, what does their business model look like moving forward and their ability to bring in money? We know this bank has been under tremendous pressure in trading this year.
Right, absolutely. And where this business goes next is a crucial question. Just reading through some of the analyst commentary, Sonali, ahead of these numbers, Wedbush talking about it facing a Hobson's choice in which it has no choice but to move forward as a standalone business, suggesting there are many things in the way of any kind of M&A. I guess we'll be looking for all kinds of clues on that front today.
We will, absolutely. And remember, you have to think about how the FDIC process has worked for the previous banks that have looked to either fall into receivership or sell assets. The firms that have looked to sell assets before they hit dire trouble, we've seen some examples here where it's worked pretty well. We don't know the buyers of all the loans that have announced, for the regional banks that have announced loan sales, asset sales, but we have seen, for example, PacWest shore up liquidity after SVB in a way that has been meaningful. Now, will First Republic have to sell any assets, let alone any standalone merger? I think that is one question. Can they shore up any liquidity that way as well? Is there any other way that they're going to announce a way to clean up their balance sheet even more ahead of, remember, a lot of these deposits that have come in from the banks, they have a time limit to them. They are uninsured deposits. So at some point, First Republic needs to have its own solution here, aside from what the big banks have already done.
So in terms of the regional banks we've seen so far and what we expect to come, this is the biggest problem of them, right?
Yeah, it certainly is. I mean, this is not an all-clear moment until we see First Republic. And remember, the reason we're talking about First Republic is if it were to hit more trouble here, there would be greater ripple effects. That's why the big banks had stepped in. Now, if you look at last week alone, I think there's another question under the surface here on how much more pressure this banking system can sustain. What happens at the end of the year? You look at last week, a lot of these firms have said they're kind of out of the woods here, they have stabilized, but then we've also seen borrowing tick up again from the Federal Reserve's emergency facilities. Yep. We've also seen last week the KBW banking index essentially flat after what investors would have considered good news. Yep. So again, the pressure that's sustained, even if today isn't all clear, is still the looming question over the industry.
All right, Sonali, thanks very much. Sonali Basak, our global finance reporter covering the banks for us. I want to just quickly, it's not really a correct, but we were looking at Stellantis shares, and they're down considerably in the pre-market. I thought, you know, it's just a high beta stock. It's not really a high beta stock, 1.16 to the S&P. And a viewer writes in and says, no, it's going ex-dividend today. So that completely explains, and then some, the drop in the shares, off 7% in the pre-market. Anna?
That is it for Early Edition. Surveillance is ahead. This is Bloomberg.